Hello, everyone, and thank you for joining us today for Citizens 2026 M&A Outlook. I'm Danielle Fugazy, a contributing editor with ACG. I'll be your host and moderator for the next hour as we talk through one of the most anticipated reports of the new year, Citizens 2026 M&A Outlook Report. This webinar is presented to you in partnership with Citizens. Before we get started, I just want to take a minute to tell you how you can participate today. You can use the Q&A feature at the bottom of your Zoom console to submit questions throughout the presentation. These questions will be monitored, and the panelists will answer as many as possible during today's presentation. This webinar is also being recorded and will be available on both Citizens and ACG's website, along with the slides from today's presentation. Thank you again for joining us. So, as many of you probably already know, Citizens is a rapidly growing commercial and investment bank offering deep sector expertise and a full suite of corporate finance, capital market and advisory, treasury and risk management solutions, from insights through to execution. This year marks their 15th annual M&A Outlook, which helps the deal-making community understand what their peers are thinking about as 2026 gets underway. And there are certainly some very interesting findings in this report, as there is actually every single year. For today, we'll be covering a variety of M&A related topics such as historic volumes, expectations for the 2026 market, buyer and seller dynamics, and valuation expertise in aggregate and by sector. And then we'll have time for Q&A. And as I mentioned earlier, please chat your questions into the Q&A panel on the Zoom console as we keep going through our presentation here, and we'll get to as many of those as we can at the end of our conversation. So with that, I'd like to start by welcoming our panelists. Thank you all for being here today. I appreciate it. And I want to ask you each to introduce yourselves. We have a lot of D's on this call today between Dave, Devin, and David. Dave Dunstan, I'm going to start with you, and we're going to go by your name being Dave. So Dave, why don't you go ahead and take it away?
Sure. Thank you, Danielle. This is Dave Dunstan. It's a pleasure to join the panel today. For some background and context for our conversation, I've been doing merger and acquisition and investment banking work since 1992, hard to believe, but over 30 years, advising public companies, private companies, PE-backed assets, and across predominantly sell side, also buy side. So look forward to sharing that perspective. Today, I run the industrial M&A practice for Citizens, which is predominantly the manufacturing and distribution of industrial products. However, our firm and this presentation covers a broad swath of industries from healthcare and tech, consumer services, industrials, of course. So looking forward to sharing my thoughts with a little bit of an industrial orientation, but certainly we will be speaking across the other verticals as well.
Thanks, Dave. Devin, thanks for joining us again this year. Why don't you go ahead and introduce yourself to the audience?
Thanks, Danielle. So Devin Ryan, I think this is the third year doing this and always enjoy the discussion and the questions. My background is over 2 decades in equity research. So I'm approaching this from an angle of studying investment banks and investment banking trends. I've covered the large cap and small cap investment banks for really my entire career and have really watched the evolution of a lot of areas of financial services. And M&A has always been an area that we've studied closely because it's been a high growth market within financial services, but it also has quite a bit of cyclicality. And so I think when we do these conversations, we're kind of thinking about the market from year to year. When we zoom out, there's kind of this really nice secular growth dynamic behind it. So looking forward to the conversation and questions, and happy to be here.
Thanks, Devin. And last but certainly not least, we have David Santonian with us. David, why don't you go ahead and introduce yourself to the audience?
Sure, Danielle. Thank you to the Citizens team for inviting me to participate in the call today. I've been in middle market investment banking my almost entire career until 2 years ago. Joined Audex Private Equity in Boston to lead business development and sourcing. Audex had been a client for 25 years and lots of good friends here. And we are, just entering our 26th year investing out of three funds, Fund 7, which is a $5.25 billion middle market fund, an Origins fund, which is just under $1 billion fund. And we've had lots of activity that we'll talk about today.
That's great. Thank you, David. Okay, so as we dig in here, I do want to turn back over to Dave so he can provide us a little bit of context around the 2026 M&A Outlook report, just so we can give the audience a little bit of background about what we're looking at here before we get into the whole report here.
Sure. I think some context is always helpful, and particularly here. So every year, Citizens engages a third-party research firm in late 2025, November timeframe, to make some outreach to very educated professionals in the M&A and C-suite environment. So we cover 400 different endpoints, being senior executives at middle market companies, as well as partners and executives within private equity, focused on the middle market, which we define as 25 million of revenue to $1 billion of revenue. So again, the context of this survey is from people very close with their finger on the pulse of their business and M&A. So a very sort of highly educated group that is providing their perspectives each year. Fortunately, I think excitingly, from the standpoint of an M&A advisor, we have a robust view with regard to 2026. So not to preview too much, but it is exciting to see we're at a 6-year high in terms of the view of our respondents in terms of the positivity around M&A opportunities for 2026. So with that, we'll get things moving, but look forward to a good conversation.
Thanks, Dave, for that background and also for the little teaser there. I don't find that the Citizens Report never really disappoints, so looking forward to it. So let's get started. Devin, you're probably best positioned to provide a perspective on the historic M&A volumes. They're perfect. The slide's up. Can you talk a little bit to the slide and what we're seeing today?
Sure, happy to, Danielle. So I think anyone that joined us the last couple of years, this slide is familiar. And what this shows is global announced M&A volumes going back 30 years. And so the dots are the annual volume. The line kind of through it dotted is kind of a trend line. And kind of the point that I made on the lead in is that M&A over long periods of time is secular growth, but it's quite cyclical. And so, I think this shows kind of the highs and the lows and kind of the extreme moves through a cycle, but kind of the up and to the right movement. So if you go back a few years, 2021 is the kind of the highest dot on the map here, where really that was a record backdrop, right? Markets were up and to the right, not a lot of volatility, and kind of perfect conditions for M&A. And then as we got into 2022, that's when you started to see the really rapid increase in interest rates, the Fed movement. And so conditions started to change abruptly, valuations shifted abruptly. And at the same time, you had the geopolitical conflict with the Ukraine-Russia war just starting. And so M&A markets really rolled over in conjunction with that. And so you see those dots after 2022, 2023, well below that trend line. And so our view in 2022 and 2023 was, now we're kind of an aberrationally slow moment, which is, the not normal cycle, and that it generally takes a couple years to bottom. And then normally it takes a couple years to get back to something more normal as markets heal and conditions kind of normalize. And so, last call last year, the view was heading into the year that M&A conditions were getting quite a bit better exiting 2024. And so I think there was a lot of enthusiasm. And you look at the dots here and you see that far right, there was a 44% increase in announced M&A volume in 2025. So the headline of M&A in 2025 is terrific, but we think that's a bit misleading. And Jeff, maybe if you want to go to the next slide here. I think the point of 2025 was conditions were absolutely improving, but as we all know, it was a very volatile year where the year started with a lot of challenges, including tariffs and the uncertainty from that. And that led to a big market sell-off as we headed through kind of March and into April and Liberation Day. And that was a really challenging backdrop, I think, for as you go down market cap, companies trying to navigate that, and what do supply chain disruptions mean, just the valuation uncertainty as well, bid-ask spreads. And so what we look at in the data in 2025 is that it actually was not the year that the headline suggests. Really was driven by large deals. So deals over $10 billion in value increased about 145%. So there's about 70 deals that really drove a third of the volume in 2025. When you go downstream, much smaller deals, which we would say are kind of the middle market deals, and I think what we're going to cover here, were much less robust. Sub $1 billion only increased about 7%. So the point is, the headline, maybe the narrative in the media was that M&A was great in 2025. It really wasn't when we think about what drives kind of the bread and butter of the M&A market. But positively, the conditions through 2025 got better as the year progressed. And I think that's going to be a lot of the message that you hear today from us, that it wasn't the best year in terms of the end state, but as it progressed and kind of exiting the year, the exit rate and the velocity there was getting quite a bit better. So I think that's kind of the setup here, and we can move on into the conversation, but just wanted to give that background from where we came from to where we are right now.
That's perfect. Thank you, Devin. I look forward to talking about what you're expecting for the middle market there for 2026. Dave, I want to move to you and talk a little bit about how you'd characterize the M&A market in 2025 and talk specifically about, private equity.
Sure.
Happy to.
Oh, sorry.
Oh, sorry.
I'm sorry.
David.
That's my fault. Let's start with you, Dave. Sorry about that.
No problem. Happy to kick it off. And it's funny looking at Devin's chart going back to 95. I've operated through all of those cycles, which may make you question my sanity as to why I continue to love this industry. But the reality is it does rebound. And it's really, I've often thought of the market as where it is on a confidence or certainty continuum. And when an industry, a sector, the broader environment has more confidence, has more certainty, M&A activity is materially more robust. And if you take a even more focused point to that, as an operator of a business, when you're anticipating a potential sale of your company and you're trying to build your forecast and think about your pipeline and think about your margins and your ability to articulate that to a buyer and for them to essentially audit that and validate that through their diligence, certainty is critical. Confidence is critical. If you dial back a year ago, we were dealing with some of the things Devin noted, the tariffs, which initially, if you recall, 100%, 200%. Of course, that wasn't the reality, but at the time, the reaction, the public market reaction, the private market reaction, the uncertainty around your pipeline, your margins, and how you're going to manage your supply chains, et cetera, was significant. There were global conflicts. There was interest rate and Fed policy complexities. And you can see through 2025, as people got more comfortable with the environment, the confidence level rose dramatically. And that is for the overall market. We can drill down and will later into different sectors. All of these things and confidence, certainty are often company specific and sector specific, but you can see the trajectory over 2025, which is leading into this more robust confidence level, certainty level, and M&A activity expectations when you think about this current year, 2026.
Thanks, Dave. David, I would like to turn over to you now, and let's talk a little bit about this and the private equity community.
Yeah, when I look at this chart, it really highlights 2025 from our perspective at Audex. We started the year slow, but ultimately, closed 9 new platforms across our origins and flagship funds. We did more than 100 add-ons, which is what we've been known for a long time. Those always continue in even slow markets. And we also sold 11 businesses. So we had a good year all around, but it was back half weighted. I'd say what gave us, confidence as a seller during the market and through the year was just the growth we were seeing in the portfolio. And as we execute our buy and build strategy and apply, ODEX value creation strategies to the portfolio, through weekly reporting, we can, make the determination when's the right time. And we had a lot of strength. And from a buyer's perspective, um, it was tough. It was competitive. There were really A assets out and not as many B and B plus assets. But we liked the challenge and finding and working with management teams and felt like it was a really successful year. And we're going to talk about this later, but we're very bullish for 26 on activity.
Yeah, that brings us perfectly into the next slide, honestly. The survey indicates that sentiment is at a 6-year high, with 58% of respondents indicating a strong M&A environment in 2026, just like you were saying, David, with PE coming in at 69%. So, David, I'm going to go back to you. You were just talking about this being in line with what you're seeing. Can you talk a little bit about what you think is driving this sentiment?
Yes, I'd say this absolutely aligns with what we're seeing. I mean, the economy is strong. Valuations are at attractive levels. Interest rates have started to reduce, and all of these things are creating tailwinds for the market and for PE firms. And I'd say, well, the beginning of 2025, as we talked about, was slow. It really accelerated in the back half of the year and has continued through the first 3 weeks of 26. I'd say along these lines, our small and lower middle market Origins Fund was particularly active last year, doing 4 platforms and selling 2 businesses, which is really proof that the lower middle market was resilient. And as you got bigger and bigger, the market was slower and picked up late.
Okay. So let's talk a little bit about where we are with the buyer and seller dynamics here. This chart is pretty compelling. I really like this chart. Companies open to selling are at a high of 79% versus those that are open to buying at a high at 61%. Sellers' top reason to sell is to take advantage of the current valuations, whereas buyers indicate M&A as a path to increase revenue and growth. Dave, let's turn over to you. Does this indicate a long-awaited opening that we've been hoping for? Or are we, just on that path, as David kind of started by saying?
Yeah, I think it's a compelling data point. Certainly, 79% is a big number. It's not overly surprising when you think about the environment that we talked about being more robust, more certainty, more clarity on interest rates, more clarity on Fed policy, more clarity on tariffs, global conflicts. Well, all of those things still exist. We're further along that path. There's more comfort with regard to being able to execute. We're seeing it with our own clients, particularly in industrials. We didn't see quite the same for manufacturers that are dealing with supply chain and tariff dynamics in a way that's almost more intense than, say, a services business, for example. It took a little longer to get traction in 2025, and we're now beginning to see that our clients have more clarity on forecast and predictability. Those kinds of things are very critical with regard to activity, but also with regard to maximizing value. I would also say on the sell side, there's a record level of portfolio companies in PE hands, as well as a extended duration. So we expect more of those deals to come to market, which will also drive selling activity, which we think is quite attractive. And for private companies, when Devin showed sort of the slowdown in M&A over the last few years and the slower uptake for the lower middle market companies, there's a lot of aging owners that are also looking for liquidity. So that high percentage of companies thinking to sell is in line with expectations, given some of the slower dynamics historically and the attractive environment. On the flip side, the buy side, we as advisors have spent a lot of time with guys like David on the PE side and strategic buyers talking about price versus volume. We've been in an era of growth driven often by price and inflation. with less volume growth often being attributing to the overall growth of the business. As inflation starts to dissipate and price action becomes more difficult to gain traction, you're going to see a real need for volume, which is hard to get. You're talking about gaining market share, taking market share, bringing new products, new customers, as well as M&A. M&A is a key component to drive growth as price growth becomes more difficult to achieve. So we think M&A is a key component, and you see as number one to increase revenue and growth. So that is in line with our expectations.
Devin, I want to turn over
Hey,
to you, get your opinion on this.
yeah, I think Dave covered it really well. Maybe to put a finer point on a couple things that he said, because when we look at the markets and we started with some of the data, there's a pattern to the markets because of conditions that kind of exist and then repeat. And so, where we are right now from a seller perspective, as Dave said, you have a really aging dynamic of portfolios. The average private equity portfolio is like 6.4 years. So that's the longest that we've tracked. It was about 5 years coming off of the 2021 peak. So, at that point, private equity firms had a couple of years to kind of figure things out, get their companies back into a good place where the pressure wasn't really as intense. Today, at your 6.4 years and kind of a high, there's a lot of expectations from LPs to get capital back. And so that pressure from a seller perspective has only been intensifying, and we're kind of far out the spectrum there. And then from a buy side, what we look at is, there's a lot of dry powder in the system. So, dry powder is called $2.5 trillion for private equity firms right now, and that's held pretty steady. And so private equity firms are in the business of deploying that dry powder. And so if you think about where we came from, there's a relationship of private equity M&A to how much dry powder they have. And historically, private equity firms have done M&A at about 80% annually of the dry powder they have in the system. And 2021, the record, it was about 100%. So that tells you we were out of balance on the upside in 2021. 2022, 2023, where you saw those really low data points, we were only at about 30% for private equity firms, meaning they still had a lot of capacity to do deals, but they weren't doing deals. It's been recovering the last 2 years, but 2025, we're still only at a little bit over 60% of PE M&A's percentage of their dry powder. And that average, as I mentioned, is over 80%. So what that tells you is that private equity firms, just to get back to the historical baseline or historical average, would need to do anywhere from 30 to 40% more volume just to be kind of back in balance. So the point is that there is a rhyme and a reason to this, and I think that's why there are cycles. But it shows you another data point. I think that we're still pretty far below what I would argue is normal, and why we think there's going to be quite a bit of upside and kind of order of magnitude of what that could look like.
Thanks for that perspective, Devin. David, I want to turn over to you. I want to get your opinion. Is that what you're also seeing from the audit standpoint, from a private equity standpoint? Lots of reasons to sell there. So let's talk a little bit about valuations as part of this conversation, David. What factors are influencing the expectations for higher valuations in 2026? As you can see here from this chart, 49% of private equity firms expect an increase in valuations, right? That goes along with people selling. Versus 39% for the companies. David, kicking it over to you. Go ahead. I don't want to start talking for you. Go ahead.
Yeah, I think, and a lot of this follows what Devin was just speaking about. There is a ton of pent-up demand and PE dry powder that people are comfortable. As we see more flow, people are going to be more comfortable in participating in processes, and when more people participate in the process, prices go up because they're competitive. And last year, I would say much of the activity, we talked about this earlier, revolved around A-plus assets, really strong growthful businesses, many of them around data centers and AI or related businesses. And I think valuations were really rich for those companies, and in some cases, deals were priced really to perfection. It made it really hard as a PE buyer to win if you didn't have true conviction on an asset. As the market, becomes more confident and deal funnels start to fill up again, that can help honestly, to moderate valuations a bit. I do think even as confidence climbs, there's the expectation in 26 is that we're going to be twice as busy as last year, if not more. And I agree, Devin, with I love your stat on how much dry powder versus how much gets invested. I've never heard anyone use that, and I think it's correct. But if what happens happens, um, I do think we'll uh, we'll see valuations moderate and not just continue to go up. There's going to be a lot of deals in the market. That will help.
Dave, Devin, anything to add there that you think is that we should talk about?
I think that was well said, Danielle. We're seeing and feeling the same dynamics as well noted by David.
Okay.
Yeah.
So let's,
All I would add, Danielle, we can
yeah.
stay on this slide too, is just that this also follows public markets as well. And as we all know, there's been a pretty big recovery in public valuations. That's kind of where I live and talk to our clients. And S&P was up, I think 16% last year, was up 23% the year before, was up in 2023 after having a tough year in 2022. But that sets a much more constructive tone for sellers to be able to go to market where they feel like they're optimizing the asset. And when you have public comps that are telling you that as well, and I think a lot of that is built on sentiment being quite a bit better over the past year around areas like the economy, which David spoke to, and interest rates starting to come down to a level that make people more comfortable, and then ultimately companies just feeling good about their business and ability to play offense here. And I think that's kind of where we are. Last year, the beginning of the year was a little bit less certain with all the complexity of dealing with tariffs, and it affected companies differently. But that just was not a broad-based market where I think people felt good. I think we're entering this year with still complexity as we do kind of every year, but some of the acute stresses just aren't as acute right now, at least as they were 12 months ago.
Well said. I want to just remind everybody that they can chat their questions into our Q&A panel that we'll be getting to shortly. But I do want to stay on valuations. You can see the next slide is up here, and we kind of talk about the valuations here and the optimism by sector. And you guys each have a bunch of sectors that you're covering and that you're going to talk about. So, Devin, let's stay with you. Can you talk a little bit about the financial sector, TMT, and healthcare?
Sure, happy to. Yeah, so I spent 20 years covering financial services. I head up our fintech research effort here as well. So I spent a lot of time in tech, and then have colleagues here that are very close to the healthcare space. And ultimately, I'm not surprised to see this. So if you think about the verticals where there's been the most enthusiasm over the past year, technology kind of year in, year out, I think is an area where people just feel like there's still so much growth, and AI is a theme, and how that's going to drive growth, and ultimately be a massive theme for that part of the industry. And a lot of tech is being pulled up by that, to be honest. But that being a big theme, and then financial services, probably the area of the market that is going to, at least in people's mind, have the biggest benefits of this new administration. You think about banks and the ability for banks to do M&A in a new regime, which was really tough in the prior regime, and we're already seeing that happen in the data. But kind of regulatory relief, capital relief on the consumer finance side, the CFPB, kind of relief, and so there's just so many facets for financial services. And interestingly, we look at data around fund flows, like how much money is coming into these verticals, and not shockingly, in 2025. Technology was by far the most. It is most years, but $75 billion of capital came into technology-centric ETFs. So you have a massive kind of support function, marginal buyer for technology. But then financial services saw about $30 billion last year of ETF buying. And if you zoom out and kind of go back, the 3 years in aggregate before 2025 were net zero. So it just tells you there was a sea change in sentiment. Both active managers and my clients, which are big, mutual funds and hedge funds, were rotating, from underweight or equal weight in financials to a more favorable position. But then you also saw that play through in the passive money too, very clearly. And then healthcare, a little bit on the other side of the spectrum. And I think we were trying to figure out why is sentiment more negative here. I mean, honestly, I think healthcare has a lot of different components to it. So if you look at medical devices, kind of the biggest part of that sector has been, I think, a little bit more negative. Biotech was really a negative coming into this new administration, kind of traded off quite a bit early into 2025. But that part of the market, which is smaller, really saw a massive recovery through 2025. And so I think there's some different stories within probably all of these verticals. But healthcare, I think the tone is, medical devices, probably a little bit softer. Biotech really gained steam exiting the year, and so we're pretty bullish on that into 2026.
Great. Dave, let's turn over to you. Talk a little bit about
Uh,
industrials here.
sure, happy to do it. Unlike most of the market that rebounded maybe second half of 2025, and we saw some robust activity, the manufacturing space was lagged. And that's predominantly driven by tariffs and certainty around that. And those manufacturers that had international content in their bill of materials or in their end markets, it just created a little bit of a headwind that made it very difficult to forecast, predict, and recommend that they pursue the market aggressively. That said, I am very bullish as it relates to industrials as we enter 26, particularly around certain verticals. Even in 2025, and I think David and maybe Devin both referenced it earlier, we saw significant momentum in certain niche verticals across the industrial landscape. Data center, for example, is an area where we had success in 25 and companies in that space that are making components, parts, etc., the HVAC components, the electrical components, the power components, the racking, the wiring and cabling that go into these data centers are thriving, and it's bigger than tariffs. The momentum and certainty and confidence in the growth of those businesses outweighed any risk associated with tariffs and other dynamics. So that category was really attractive, and we saw a lot of success in 25. Expect continued growth, not just in 2026, but beyond. When you filter that down into areas that fall into infrastructure, electrical products, the grid, when you go further into semiconductor, that's an area where there's a lot of investment, and we're starting to see the parts and components and the infrastructure that funnel into that pick up nicely. And the effect of reshoring. A lot of the tariff dynamics have forced companies to think about their supply chain in a different way. And we're seeing more of our clients getting RFPs and opportunity related to reshoring dynamics, which we'll start to see in 26, demonstrated in their financial performance. So confidence is up, predictability is up, pipelines are up, significant growth in certain verticals, and we feel the opportunity in industrials is primed for activity in 26 and beyond. Great place to be investors, whether you're private equity or strategic.
So much optimism today. It's so good. Let's turn over to David, and why don't you talk to us a little bit about business services and A&D?
Sure. And at Audex, we have five core specializations, including business services, and then A&D fits in either our business services or our industrial services and technology vertical. And we had lots of activity in both areas this past year. I think on the A&D side, the global conflicts that Devin mentioned earlier certainly created demand for A&D related connectors and products, and we successfully exited our large connector business last year. We've done acquisitions in the space for another portfolio company and continue to be active in the space. Business services is a pretty broad term. We were very active as both buy and seller in business services this past year. We will be in 26 as well. Really, we really are bullish. So,
All right. Sounds good. So just kind of changing the tone a little bit here. We're going to, we have another slide left that we're going to show right here about transition planning, and then we're going to get into our Q&A. So talking about transition planning, Dave, I'm going to go back to you. According to the study, 19% of companies plan to sell, which is up 5% from last year. 30% have a succession plan in place, but 51% have no transition plan in place. Actually, 52% have no transition plan in place. Does that surprise you? What do you think about this slide? What is it telling you?
Well, Danielle, I think over the many years I've been doing this, I can't emphasize enough the benefit to someone contemplating a sale to prepare for that event. There are many things you can do. Succession planning is part of that. Succession planning takes time, so the more time in advance of any transaction you pursue addressing these things, the better. And I think it's not just people, it's not just do you have people in place that could step into your shoes and lead the business, or be the next CFO or be the next head of supply chain or whatever the position might be, but that you've also thought about the wealth transfer, the taxes, the structure, your contracts. There's a lot of related succession planning dynamics that are really critical. And I would highly recommend, as a promotion to the advisors, the lawyers, the accountants, the wealth advisors, etc., for business owners to get in front of those folks early. There's a lot that can be done around transition planning. From an M&A advisor standpoint, we often get engaged. The company wants to sell. The owner of the business, in some cases, particularly in the lower middle market, may have the customer relationships. They may do all the new product and idea generation. They're the culture leader for the organization, but they want to exit. And then we go to David and say, hey, man, we got this great company we want to sell. But the guy that really is doing all of the customer interaction, the growth, driving the culture, he wants to exit. Now, if that individual is able to identify people and has transferred some of that to the next generation, it makes it much easier in a management presentation, in a meeting, in a negotiation to get full value for that business. So really a critical component in the overall M&A dynamic, and certainly encourage this among other things. It's very important. The sooner you interact with professionals that can help you think through these matters, the much better your opportunity will be when you think about an exit.
I think that David is going to probably back up your point to a T, but I would like to turn it over to David because, as you said, Dave, then you go to a guy like David and you're ready to sell, and then these problems arise when people don't have these plans in place. David, do you want to just talk quickly about that, or what
Sure.
you're
And
seeing?
I think one of the things that private equity can provide is succession planning. And we really offer a compelling and kind of a differentiated solution to business owners. One stat that surprised me, and I've been doing this for a long time, but since inception at Audex, we've done more than 1,000 acquisitions of founder-owned or management-owned businesses. And generally, as a part of those deals, management teams roll over equity and invest alongside us. So from a transition planning perspective, we provide liquidity and a strategy and resources to help them grow and have, what we talk about as a second bite at the apple. And for a lot of owners, a transition plan isn't obvious. So private equity does provide a solution for them, whether they want to continue with the business to grow it or just sell outright. So it's an important part of the ecosystem.
Thank you for that. So we're gonna put up, yeah, so right there on your screen, you can see there's a QR code there that you can use to download the report, the full report from Citizens. And we're gonna get into our Q&A. I'll just remind everybody one more time. You can chat your questions into the Q&A panel at the bottom of your console there. So people have been putting questions in, have been chatting questions to me throughout the presentation. So thank you guys for that. I think let's get into some of them if you guys are good with that. Okay, so the first question, and honestly, I was thinking about this too, so I'm glad somebody asked it when we were talking about a few slides ago, valuations and seller buyer sentiment. What are your thoughts on the impact of continuation funds and LPs selling to other LPs? How is that impacting the exits for M&A? A stumper.
Who
Well,
wants to take lead?
yeah, go ahead, David.
No? Okay, I can talk about the LPs selling the other LPs for a bit. And I think Dave and I have both been doing this long enough that there was a time where LPs did not sell to other LPs, and an LP would not, you know, be interested. And now it's picked up.
Yeah, I think the continuation fund is an interesting dynamic too. I mean, it gives PE opportunity to better time the exit instead of being forced based on just the tenor of their fund, which is, I think, maybe LPs would like to see liquidity, but you want to sell at the right time. And when you have a asset that is better held and exited at a 12 months, 24 months later versus forcing it based on the timing of a fund, I mean, I think that's a healthy environment. As an advisor, obviously we want to see that M&A activity and the volume, but the environment for the last few years has not been ideal. Exiting when it's a bad environment for that particular company is not in the best interest typically of the fund or their LPs, and using a continuation vehicle allows you to better time the exit, which should generate better returns for their investors. And I think that's healthy. And it's definitely to your point, David, 10, 20 years ago, the idea that LPs would be doing transactions between themselves or even the concept of the continuation vehicle, all of that has become more in vogue and more popular, particularly in this last cycle than I've seen historically.
Great. Okay, next question. What financial and business profiles will acquirers target in 2026? So are they looking at the stress or high performers? What kind of, I think we talked a little bit about the A plus assets versus now some Bs, but any thoughts on that?
I mean, I could start for a moment. First of all, I think we all agree that we think the breadth of the market will expand. It was very much an A plus market only environment in terms of getting deals done in 25 because of the uncertainty and risk profile associated with some of these external broader macro factors. PE group strategics were very focused on just like the core critical mission that they had in certain sectors and on those A assets. We expect as the market broadens, the market improves, that the M&A environment will broaden. It'll be the B assets as well can trade and can trade at reasonable value. All that said, a common theme that emerged and has always been true, but emerged particularly over the last year was around predictability, recurring revenue. And we saw that in industrial equipment manufacturing, there were some challenges. Industrial services killed it. That marketplace where you had contracts, recurring and predictable revenue was red hot. Licensing, software, things where you can see and feel the forecast in a more meaningful way than sort of a theoretical pipeline that may or may not be actionable. These are contracted, recurring, predictable. So anything we spend time often with our manufacturing clients, how can you make your pipeline, your forecast, your business feel more predictable? It may not be recurring contracts and licenses. It may be more around sort of the pipeline and the actionability of it. But the bottom line is anything you can do to your business that gives it more certainty around predictability, the higher the multiple and the more aggressive buyers will be.
Okay. Are you seeing higher volume or any other differentiating factors in certain markets, such as the state of Florida, given the pro-business climate of the state administration?
I can't
Yeah,
speak to regional. I don't know,
yeah.
David, do you see it regionally, state by state?
No, we don't follow the markets that way. I don't know if Devin has any stats on it.
Yeah, I wouldn't say I have any specific data points, but I think as a general theme, this theme of kind of deregulation, more business-friendly conditions, it creates that confidence where, we talked about at the beginning, like where the conditions for M&A. It's you're not playing defense on your back foot, you're playing offense. You feel good about your business, you want to build your business, you want to expand your business. So you need those types of conditions. You need kind of the macro market to be somewhat steady because that's going to dictate the valuation, but buyers are going to have more confidence coming in and paying you a reasonable price. So that'll kind of tighten the bid-ask spread. And then, in those kind of pro-business conditions, generally kind of financing markets are going to be available in that type of backdrop. And I think those are all ingredients of a really healthy M&A market. So without going overly on one, state by state, I do think that that type of environment, if it's paired with kind of a broader macro condition for the markets, is bullish for kind of even micro deal by deal or sector by sector within jurisdiction, states, or municipalities even.
Okay, great. Devin, I think this next question is for you. I think you touched on it in the beginning. Do you expect AI to drive consistent mid-market M&A in 2026, or will the deals stay concentrated for a few big players?
I think that's a great question, and there's a lot of components to it. So I think AI thematically. I mean, we're still in the early innings of kind of figuring out where we go here, but every single company that I know of, and probably every single board is discussing what is their strategy around how can they leverage AI internally to be more efficient or leverage the data that they've compiled over years and years and harness that, or how can they be more productive. And so I think we're still kind of scratching the surface on all the use cases, but it's clear the direction of travel is that people realize that this is going to be a big deal and you're going to have to integrate it more. So I think the answer is it depends like company by company. In the tech sector, I think a lot of companies want to have AI integrated into their tech stack. So they're offering their customers, services that connect with AI. So you've seen to that question, some mega deals around AI just over the past year. I think Google bought Wiz for $30 billion. That was one of the biggest, it's more of a security AI deal, but just large deals. IBM did a deal, Salesforce did a deal, but like all these are multi-billion, Meta doing deals, kind of multi-billion dollar types of transactions. I think there's going to be a lot more at that surface level in tech where companies see that they need more capabilities in AI. From there, then I think it gets really interesting. I think Dave hit on this. There's downstream impacts too. So you look at the whole data center complex and just the amount of capital coming into that because we need more power to support all of this. And so that's creating M&A opportunities both directly in data centers and kind of adjacent to that. But then even who are the firms that are powering the data centers and who's the manufacturing and the equipment firms and all of that. There's just a huge theme around this where there's so much capital in the economy coming to it. So I think offensively, there's a lot that the company should be thinking about. Is there's going to be a lot of downstream type of activity attached to this that's maybe not as directly obvious. But then I think there's a second element to the question. It's a great question because it's not just offense, it's defense. Are you as a company set up to compete in a world where AI is potentially going to replace parts of what you do as an organization, or are you not modern enough as a operation to be competitive in this new world? And so I do think it's going to change things. When I look at even my world of fintech and financial services, companies that are leaning in, I think can accelerate their roadmaps over the next few years, and we'll look back in 3 or 4 years and say the ones that did it well really leapfrogged others. And so I think that's an important component. And then also, data, right? So data is such a critical piece of what powers AI. And so I think there'll probably be acquisitions where companies that maybe are old economy companies, but they have decades of data are now more valuable simply because of the data that they have. Maybe the business model itself isn't as valuable, but they've got records and data and customer information from decades and decades that an AI-centric company could leverage. So I think it's going to get really interesting over the next few years attached to the theme, but I don't think it's going to be exactly what people think. I think it's going to be much broader as there's going to be a lot of second and third derivatives of what AI means for M&A markets and as a catalyst. And I hope and I know that boards are all talking about this is how can this impact our business and trying to look out a few years from now. And that's going to be a catalyst for quite a bit of activity.
There was no way we were going to get through a whole webinar and not talk about AI. I'm going to ask you guys a few more questions, and then I'm going to ask you just for some closing remarks. We're getting to the end of our time here together. So somebody wanted to talk back about the transition, the succession planning. How far in advance of of actively pursuing a sale, would you recommend an owner begin the planning process? And what does that team look like?
I mean, I'm happy to start. I would just look, the sooner the better, but generally speaking, at least 12 months. These things take time, and moreover, with regard to transferring shares to next generation, any evidence of valuation or a potential sale can trigger a review, and maybe the impact of achieving a discount could be mitigated if you are too far along in a sale process. So, anything you can do early with regard to building a team, building a bench, thinking about succession, thinking about the structure of your company, thinking about the transfer of wealth if you're trying to accomplish that objective. All of that done at least 12 months, if not more in advance, is a best practice. Unfortunately, we often get involved and they want to move right away and they haven't done any of these things. Some things can still be accomplished, but you will leave some things on the table, some dollars and some opportunity on the table if you don't plan, well in advance, at least 12 months.
David, I want to come over to you for a PE perspective. How significant is the role of improving valuations in bringing the backlog to market? How significant is the role of improving valuations and bringing
Yeah, I mean,
backlog to market?
it's not insignificant. But anytime we decide to bring a portfolio company to market, we really need to make sure that our business has reached all of the outcomes that we identified when we initially did the underwriting. We have goals for organic growth as part of our value agenda, add-on acquisitions to grow marketplaces, expand the addressable market, expand into new geographies. There are operational goals in terms of getting in place the right corporate infrastructure, technology, team members. And as we reach those objectives, we'll do a fair amount of pre-marketing work with bankers like Citizens to go out and talk to people to really hone in on finding the right buyer from the asset. And so the market is a factor. But if we do everything right with our underwriting, it becomes less of a consideration. We know when it's time to take a business out, and valuations for good businesses, and if you do your job and build a good business, have always been strong.
So I want to ask you two more questions because I don't want to end on this question, but I do think it's a fair question that we should ask. There's been a lot of optimism and talk about the tailwinds, which is great, but are there any headwinds that you're worried about or that you think there's always a headwind, right, that you guys are thinking about? Can you just share those with us?
Danielle, it's Devin. Maybe I start here. I'm sure Dave and David have things that keep them up at night as well. I think the first point from my perspective is, there is a cycle to all of this. And so, and that cycle follows kind of somewhat of a not completely predictable cadence, but a cadence. And so that's, I think, helping support our optimism that the conditions are all coming together. And then here we are years into kind of a prolonged recovery, and we're still in certain parts of the market nowhere close to normal or functioning market. And so a lot of that is like the optimism element of it here. And we think that, and I think that overcomes, any of the negatives, the intensity of the positives outweigh the negatives. That being said, we came into last year, and I think there was a lot of enthusiasm, not quite to the degree of where we are right now. Tariffs were just starting to become a little bit of an issue for the equity markets, but equity markets were bumping into highs. That to me, when I look at like M&A connected to one specific item, it's really equity valuations. And at the most crude level, it's just where's the S&P 500. And when you have the S&P trade off 10 or 20%, what that does is essentially it just creates a chilling pause for the market where everybody has to take a minute, reevaluate, is this really a deal I want to do, or is this the price I can pay? Because generally, everything has changed in that type of environment, and people are a little bit less excited, right? And so I do think that we are at a moment where, because we're so many years into this kind of duration of portfolios, that's the piece that's going to be most important. But we're looking at, what is market sentiment? Some of these macro risks, tariffs are still out there. You have plenty of other, kind of geopolitical issues that everybody's paying attention to. But really, from an M&A perspective, people can't wait around for another 5 years or 10 years. So when you get these windows and it feels like the conditions are in place, our view is that you kind of have to go because that window may close and we don't know what 9 months ahead will look like. And so right now, what we do see is that window being open, which is supporting at least my optimism of what we're tracking in the market.
That's great. I don't know. Well, I have to share a disclosure with you. So we're going to get that up on the screen. It's two disclosure pages that we've been asked to share here. So as we're doing that, I want to just kind of do a round robin and get any closing remarks from the uh, panelists. Any takeaway or action items that our audience should be considering. Dave, why don't we start with you?
Sure. I will piggyback on the succession planning discussion. Um, M&A advisors focused on industry with experience in that space can add a lot of value to a company contemplating a sale, not just with regard to succession planning, but thinking about how to optimize the business for the event. So much like succession planning, building a team, which plug for advisors, I suppose, but including M&A advisors, including legal, accounting, um, in preparation for something that could be 2, 3, 4, 5 years out is not unusual. It is to the great benefit. The nice thing about M&A advisors, there's no hourly rate, right? Like we're providing this advice to build a relationship so we can help you when the event occurs. And we're happy to do that in order to build relationships. So I would recommend reaching out if you're contemplating whether you're buying or selling to a team of advisors, build that team, stay in contact with that group, keep them apprised of what you're thinking and doing. And whenever that is, if it's 90 days away, if it's 2 years, I have clients that I've worked with for 15 years from the first introduction until the transaction occurred. So, um, we're happy. It's mission critical. It's really important. I would encourage people to reach out and explore that before pursuing a transaction.
Thank you, Dave. Devin, any parting remarks, thoughts?
I would just probably repeat what I just said. Essentially, we are in a part of the market right now from what we track that is normalizing, but we're getting pretty close to what I would say is normal. So, conditions are never perfect. And, there's a window right now in our view where there's a fair amount of activity that's going to be happening, and that window may close. So, from what we observe, conditions are about as good as they could be across, every vertical is different, and M&A isn't one thing. It's not one market cap or one sector, but broad conditions right now, from what we track from a 30,000 foot level, are quite constructive. And, in theory, we're going to get back to a moment where we have a 2021 like moment again where things are frothy. And then very quickly after that, it will be the opposite. And then we're potentially 2 or 3 years of waiting in kind of a trough like environment to get back again to something that's healthy. So right now it feels quite healthy. And a lot of the data we look at suggests that we're kind of getting into more of a normal environment. And this is going to be a year where that window is open.
Strike while you can. Thank you, Devin. And David?
Yep. Thanks for having me on this call. And why I'd like to disagree with Dave and tell everyone to just come straight to us. I know that's not realistic. I think your advice, Dave, was spot on. Like hiring a professional team to run and get prepared for a process that can take 6 to 9 months in some cases, sometimes longer, is really important. And as a private equity fund with a portfolio of over 62 assets, we don't do anything without hiring an advisor either. So while we're really good at buying businesses, like when we go to sell, we definitely hire outside. And I think it takes preparation. So I think those were wise words.
I want to thank the three of you so much for spending your time with us today and sharing your insights. I think that year over year, everybody looks forward to the Citizens Outlook report and helps them kind of get ready for the year ahead. And I feel like everything you guys shared was really pretty great news going forward. So thank you. And I want to thank the audience also for joining us today. Have a great day, everybody. And don't forget to download the report. Thank you.